We are staying with Anthem. Now, what I've learned over the last year, that Anthem has several different networks. We always knew that. Connecticut had a local network. What was that called? Blue Care Network, okay? And then the national, people will call them, or out-of-state locations, they had the PPO network, or it was called Century Preferred. The new products that we're offering as of our renewal are for July 1 are all going to be on the Century Preferred PPO network. So everybody's going to get the whole same network, nationwide network. So I'll tell you what that means. Now what that means is, potentially, there is a slight chance that your doctor takes Blue Care but does not take Century Preferred. So you do want to go ahead and double check with your doctors. Look it up either under anthem.com or you call them. Now again, if I call my doctor and say, hey, do you take Anthem? Every doctor's going to say yes. Even if they don't not in their network. So the right way is, are you in the Anthem network? The answer should be hopefully yes. Then you want to go, I would like to clarify that. I want to know if you're in the Century Preferred network. That is the network everybody's going to be in. So like Josh said to us earlier, hey, great, it's easy. One plan for all of you. One network is really the right way, okay? One network. Now, as of July 1, we are going to offer, Norcom is going to offer 3 different flavors of a high deductible plan. Now, has anybody ever heard of a high deductible plan? Seriously, raise your hands. Have you ever been covered under one? Okay? No? What? All right. So I'll pick on you all. No, you can come on up here.
It's more my wife.
Oh, yeah, right. That's usually what it is. Okay? Now, a high deductible plan is pretty cool. Health insurance nowadays, as premiums keep rising, they have an easy tagline, pay now or pay later. These are the style of plans where you hope to pay, maybe or not, you don't want to, but you're going to pay a lot less now. That's the whole goal. Okay? So we color code everything, so we're always going to refer to the plans yellow, blue, and purple. Okay? Again, they're all Anthem, all Century Preferred. What your choice will be, and you're going to get back to Lynn and to Josh, what you're going to choose, okay, which one you want. And if you are married, the whole family has to be on one or the other. There's no mixing. The worst that your decision lasts is 1 year. Because next renewal, you will have the opportunity to change. Okay? So, HDHP or high deductible plan. These have been around now for probably, 12 years, 15 years or so now. This is, again, a plan that was trying to address the ever-increasing cost of health insurance. So what we've done is, let's start with the purple. This one, and again, we have 3 plans. I'm going to start down here, the purple on my whiteboard. Apologize after other sides of it. We've nicknamed this, again, you guys are insurance and mortgage, I'm sure the same thing. We got a lot of jargon. So this is a 2-4 plan. So what the 2-4 means is, if, okay, we covered up my purple.
Sorry about that.
That's okay. So if we're a single person or single insured, so if your wife is covered somewhere else and you want to be on this plan as a single, your deductible is $2,000. If I'm a family, and that's defined as a spouse, you and your spouse, or you and 1 child or more, you absolutely, literally throw out the individual deductible and you go to the $4,000. Okay? Now what goes towards that deductible? Does anybody know? Everything. Except for proper preventative services. So with all these high deductible plans, what's neat about them when we have all high deductible plans, they all work the same. I have one, I've had one now since 2006, so 9 years. When I go to the doctor, show them my card, while I'm having my medical consultation with the doctor or whatever, they're contacting Anthem and trying to figure out how much I'm going to owe that day. And the way it's coded in, they typically say when I leave, it's every single time, oh, you owe nothing today. So this is out of my doctor's office. So I walk out of there without paying, but I know I'm going to get a bill someday. Because I know I have not reached either my $2,000 or $4,000 deductible. Again, my insurance people here, that with the auto and homeowners, the deductible is something that the individual pays until you hit that number, then the insurance company will kick in. So let's say, and I don't mind, I have issues with my hands and everything, so I recently went to my hand doctor, surgeon, and I saw the doctor for 15 minutes. I walked out of there without paying. The doctor, then I got an EOB in the mail. Does everybody know what an EOB is? Explanation of benefits from Anthem that said, oh yeah, we saw Dr. Gabau in Bloomfield, and didn't say how long it was, but we saw that he tried to charge $110 for that 15 minutes. We discounted it, the feature being in the network, down to $65. So now, was my first claim of the year, so I know that I'm going to get a bill from the doctor's office for $65. And lo and behold, within a week, there I got the envelope from Dr. Gabau, that I owe him $65. That's not a copay, it's a what I call network discounted expense, and I'm responsible for it because of my deductible. Now, if that's my only expense for the whole year, I'll teach you which plan is going to be best for you, okay? Now, let's say I go to I have allergies right now. Something kicked in this past week, okay? Let's say I feel really, really terrible and I'm like, you know what, I'm going to the doctor. So again, same thing, I go see the doctor, I walk out without paying. Now that doctor says, yeah, we recognize, those are allergies or whatever, but I'm going to prescribe you a prescription. Not over the counter, but one that has to be dispensed by a pharmacist. So he calls into Walgreens for me, and now I go to Walgreens to pick up my prescription. Now, when I pick up that prescription, they've already worked out behind the scenes how much I'm going to pay for that prescription. No longer a copay, I'm going to pay the full discounted rate of that prescription. So years ago I did get Nasonex, which is a mild steroid for all this stuff, and it was $78.80. Notice I know how much things cost now, because I'm paying for all those expenses underneath my deductible. Now, if I tried to walk out of there without paying for it at that time, what's that called? Stealing, theft, right, exactly. So I had to pay right then and there, okay, on that. Because again, they worked it out behind the scenes with the PBM, the Pharmacy Benefit Manager. That $78 went towards my deductible, okay? So you see a trend here, everything I do counts towards the deductible. Now, I went and get my physical, okay, my annual physical. Are they free? Okay? Federal law started since September 23rd, 2010. All annual physical exams are free. Okay? Now, it all depends on the coding, meaning what the doctor codes in. Has anybody gone for what they thought their free physical under your current plan and had to pay a copay? Okay? Because your doctor coded it in as a diagnostic visit. I have Pro Health. When I go in and see them, they go ahead and say, hey, we have the right to code your physical exam into a diagnostic, or they call it a sick visit, okay? And it'll go towards your deductible or pay applicable copays. Then, if you don't like that, come back a second time, okay? So that doctors get paid more if there's something wrong with you rather than preventative. So a lot of them, they don't like coding in it as preventative. Now, certain blood tests and stuff actually weren't covered, so guess what? I had to pay for that because it was underneath my deductible. So you get used to it. So you learn, hey doc, do I really want this test or not, or whatever. You'll ask those questions, okay? Now, we've talked about everything. Well, again, preventative exam, it should be free. Preventative age-appropriate mammographies and age-appropriate colonoscopies should be free. It's all about the coding, okay? So anytime, obviously, prior to that procedure, really work with your doctor saying, hey, I came in here as a preventative exam, I'm leaving as a preventative exam. So we've talked about, a little, again, about the deductible. And those numbers, we're going, what I call from 0 to 60, like a car, in a nanosecond. We're used to co-pays. Now we're introducing pure deductible plans. How do I fund that deductible if I want to? Well, actually, I put down 3 ways, but you actually have a fourth. You can then just pay for these expenses out of your cash flow, out of your checking account at any time. So you don't have to set any money aside. First of all, that's always your right and your prerogative, okay? You understand what I mean by that? So if you're like, hey, I'm not gonna have any expenses or whatever, and then you have that bad year, I'll just, whatever, and you gotta pay for it. Now, with these high deductible plans, the government said, hey, you can combine it with a special bank account. That special bank account is called an HSA, Health Savings Account, okay? And if you want to, over a 12 months, right now, currently, you can put away $3,300 and $3,350 into that HSA bank account. Well, if I have a $2,000 deductible, I can actually, over a course of the year, put more money away in that bank account than my deductible. It's pretty cool, okay? Now, this is an HSA, different than the flexible spending account. So what happens is, you would set up a separate bank account, you'd get a checkbook, you might even get a debit card with it, okay? Now the incentive is just the opposite of the flexible spending account because that money's yours. It goes in there and you're able to take a tax deduction on it for federal and state taxes, okay? Then every month, whatever money's in that bank account, you can actually earn interest on. That interest is tax-free also. And people always ask me, what happens if I don't spend that money? Well, it, quote unquote, rolls over year after year after year, okay? So it's almost the polar opposite of the flexible spending account plan. You now have incentive not to spend that money so that it accumulates year after year after year, okay? And again, the interest is tax-free. Now, let's just use my example. Let's say I've got a couple grand in my HSA, and now I go to that Dr. Gabao and I gotta pay 65 bucks. Well, I can write the check out of that HSA for that $65, and it comes out of that account tax-free. So I literally put it in pre-tax, accumulate tax-free, and spend it on proper medical expenses, all tax-free. Notice I said proper medical expenses. Not only is it expenses that go towards your deductible, and we'll talk about after your deductible in a second, but it also includes my glasses. It also includes my dental work. It's all the same expenses as your flexible spending account plan. Technically by law, they call it all medical expenses under the code section 213, if you ever want to look at that up, okay? But it's all those expenses. Now, the whole goal though is I don't want to waste my money on glasses and dental or reoccurring expenses because the whole goal of the health savings account is to accumulate. Maybe you start the first year with a lower deductible, and then we go to, if I have a lot more money in my HSA in a couple years, hey, maybe I'll take a little bit more risk with a bigger deductible. And you can see here we've got small, medium, and large deductibles. A 2.4, a 3.6, and a 5.10. Add thousands to all of those, okay? 5.10 is pretty scary, isn't it? 5,000, I'm talking 10,000 in a 12-month period a family could pay. Well, who would want to take this plan? That's where, too, we have in your sheets, look at the payroll deductions. If I'm going to bank, literally bank, knock on head, knock on wood, here, bank over the next year, I'm going to have virtually no medical expenses. Why prepay the insurance company that money, okay, and keep it in premium, or take that extra savings and that's where you put it into the HSA, okay? Again, pay now, pay later. It's an ultimate way for you to manage your own accounts. Okay? If I have $1,000 worth of medical expenses over the whole year, which plan am I best in? Most likely the yellow plan. I never hit my deductible here, here, or here, but I enjoyed 12 months of lower payroll deductions. Okay? And then I build up that HSA so that if that gray day ever happens, I feel a little less stressed because I have money in my HSA bank account. The whole goal of the HSA bank account, though, is to try to accumulate as much money so that when we hit 65, you'll have that money available to you to help pay for your expenses when you're in your golden years under Medicare. Okay? That's really the whole goal of the plan and everything. Some people can do it, some people can't. Okay? Now, I only think there's really one negative about these plans, and that's why we wanted to put 3 different levels in here. Our prescriptions. There is a recent study in the state of Connecticut. 46% of Connecticut residents have a chronic condition. Now they said residents, so that means kids too and everything like that. So probably half of Connecticut people are taking a prescription. Now remember, prescriptions, do I pay a copay for that? No, it all flows through the deductible. Okay? So that's where, too, you'll get to know the cost of your prescriptions. Some of them are no more than $10 a month. I know plenty of people paying $200, $300, $400, $500 a month in prescriptions. So you want to work with, see, again, we'll do the math in a little bit. Now, what's cool about, again, those are your deductibles. If I hit my deductible in the year, before the year's over, but I'm still using the purple one, and then I go to the doc, so if I'm single, and if I have that, hit the $2,000 deductible, and then I want to go to my primary care, now I pay $40. Then we get into copay world with these particular plans, okay? So here, I pay copays for everything. Now, just like your current medical plan, by law, by federal law, all medical plans have to have a maximum out of pocket. So this is the worst case. When I wake up in the morning on July 1st, the worst I can pay is $6,450. Now, that's as a single. So that means $2,000 of the $6,450 is the deductible. So that means I have $4,450 left of copays. Now that would be pretty hard to hit at $40 a clip. That'd be like 100 visits, right? Okay? So it's pretty hard to hit that by copays. Your prescriptions also count towards A, your deductible, and then B, after the deductible, you see your generic or tier 1 drugs are $5. That's new federal law, okay? So that $5 will count towards your $6,450. So everything you pay, A, first goes towards your deductible, B, then goes towards your maximum out of pocket, okay? So what's interesting is you can see, and this is the maximum allowed by law from our federal government. All 3 of them are the same. Now, obviously, here, the yellow one, I could potentially get there quicker. Because here, I have to pay the first $5,000 as a single, not $2,000, but now I've satisfied $5,000. Now I've got $1,450 left. Now what's cool about this one, they say, hey, we'll make your deductible so big, but then we'll reward you. If you do go over your deductible, this is covered at 100%. You pay nothing. All you pay are prescription copays, which would count towards that. So what's easy now, too, is I take my payroll deductions. You guys are easy. Multiply by 12. If I know I'm going to hit that maximum, then I'm going to take my premium per month times 12 plus my maximum out of pocket, whichever's the least expensive, that one is probably the best plan for you.